Happy Friday. I hope you've had a good week and are ready for a good weekend and another, hopefully, good week next week. Now, it hasn't been such an easy week in markets, for us at least, that are short. However, I think we're getting the Goldilocks short opportunity, and I think that is being proven out today with some unusual things that are happening that haven't been happening for several weeks. What is that? What is this unusual thing that has happened? The market has finally begun to come around to the Fed and to prioritize closing the gap between the market and the Fed and trying to fight the Fed, we'll call it. What do I mean by that? I mean, we got cooler than expected retail sales. These were pretty weak retail sales, and rates still went up meaningfully today. And we crossed meaningful numbers. I'm talking above 3.5 in the 10-year. We were below 3.4 just a couple days ago. And in the past couple days, all we've gotten in terms of data is weaker PPI than expected and weaker retail sales than expected, weaker import and export prices than expected. And one more thing we're going to talk about in a second, but we got weak data. We got weak CPI, and the rates have gone up. So that's a very good and very crucial thing. Central to our downside thesis is the notion that there's a massive dislocation, probably the largest dislocation we've seen during the entire tightening cycle, between the Fed's projections, which they are very public and vocal about. This is not my projection of what the Fed's going to do. This is the Fed's conservative projection based on what they put out days after the banking crisis. So based on what they said today, it would have been higher without that. And we all know there hasn't been a whole lot of banking stress since. So we got plenty to talk about. We're gonna talk about that in a second. But the point I'm trying to get at is we're seeing yields go up and we're getting cool data. Okay, this has not happened before, and it's happening right now. So be prepared. That's why we're seeing a lot of market volatility today. But yields are the deciding factor. They're the deciding force. And once they get higher, the biggest players in the market, they're not trying to make 100% returns a year like us. They're not. They're massive pension funds who get paid as a percentage of total assets and just need to see some level of growth. So they're going to switch to bonds in a recession, and we're going to get to that in a second too. Next thing I want to talk about, the Fed's premise, the reason why they were able to downshift to 25 basis points and, pause and wait for things to play out through the economy, kind of evaluate in 6 months where things are, is because inflation expectations were well anchored. How many times has Powell said inflation expectations are well anchored? A lot. You can go look that up for yourself, but he said it a lot. Today, Michigan consumer sentiment came out, and Michigan 1 year from now inflation expectations came out at 4.6 instead of 3.7 expected and 3.6 previous. So this is a massive outlier jump, and it confirms what we got just, I believe, sometime last week, maybe even this week. It might have been Thursday of last week. New York Fed saying that inflation expectations had jumped. That was odd, okay, but nobody's talking about it. We haven't had any Fed speak since the Michigan consumer sentiment number came out, but that definitely scares them. And leading up to today, they've been talking a lot of hawkish stuff and possibly even talking more than one additional rate hike. So I don't know how they're going to respond to this inflation expectations becoming unanchored thing, but I think it's pretty important. Also pretty important is this is what makes it ultimately the Goldilocks situation. In most recessions, the Fed cuts rates very early. They see the recession coming. They want to cut interest rates to stimulate growth, prevent things from getting bad. I'm not saying we're entering the biggest recession or that this is going to be an unusually large recession. What I'm saying is we know falling interest rates makes it easier to buy stocks. And typically in a recession, you have earnings declining. You also have interest rates falling. In this recession, we might have interest rates not falling, actually going up, and earnings declining. That is not a very good combination for stocks. So it remains to be seen. This is obviously future speculation, but I expect interest rates to go up, and the Fed because the Fed does, and the Fed also seems to expect a recession to occur. Even Goolsbee, the most dovish member, said, we've raised 500 basis points like in a year. It's not like a recession is not on the table. Come on, guys. Like, it's obviously a possibility. And he's right. That's just him being an honest dude. So, higher rates in a recession, not good for stocks. Debate me on that. That is a fact. I'm happy to engage in that debate, but there's nothing you can do about that. That's just the way it is. We saw how that played out last year without a recession. Just rising rates. And we got an increase in the dot plot from the December dot plot. So things are they're going higher, and the growth outlook's not looking so good. Now, I know you might want to talk about the banks that benefited from the crisis reporting earnings today. JP Morgan, the number one bank in the business. This is like a eat or be eaten environment. So one man's loss, the regional bank's loss, is another man's gain, JP Morgan's gain. JP Morgan already doesn't pay you interest on the account because now, all of a sudden, it's become you don't care because you know your money is actually safe there. So you're just going to go there and you're not going to care about your 2, 3, 4%. So while all the smaller banks have to pay more money to keep the deposits in, JP Morgan is able to pay less money, has more money inflowing versus actually they don't even have money inflowing, but they have less money outflowing than smaller banks. And they're in a very competitive position. So I'm not going to say that this is the entire banking sector, but I don't think a banking crisis is really on the table, so I'm not caring too much about banks. Banks are overall very cheap stocks. Many of them are forecasting a recession later this year. Jamie Dimon, JP Morgan, forecasting a recession later this year. Fed is forecasting a recession later this year. I'm going to assume there's a reasonable probability of a recession later this year. And I think there's a tech recession now. I think there was a tech recession last year, and I think it's going to continue. We saw what Amazon said yesterday. They said cloud growth is slowing. Yesterday was a very weird day. At one point today, we had given most of the gains from yesterday back. Again, we're not really caring about the day-to-day. We're sticking to the fundamentals. The massive divergence between the Fed and the market, the possible recession coming, the tech overvaluations, yields needing to go up, all these kinds of things. So today's one day, yesterday was one day, next week is going to be 1 week, but it's going to be 5 days. So we'll see what happens just next week. Have a good weekend, and until Monday, peace out.